Today, we're exploring a crucial topic for anyone looking to secure their financial future: how to protect your wealth, the importance of diversification. In an unpredictable world, safeguarding your assets is more important than ever, and diversification is key to managing risk and maximizing growth. We'll break down what diversification really means, how it works across different asset classes, and why spreading your investments can help protect you from market volatility. Whether you're new to investing or looking to strengthen your portfolio, stay tuned as we dive into why diversification is essential for building and preserving wealth. Today, we will talk about how to protect your wealth, the importance of diversification. So before we get started, make sure to hit that like button. Also subscribe to my channel. Economic downturns, market crashes, or sudden changes in industries, these can all chip away at your hard-earned money if you're not prepared. But here's the good news. There's one proven strategy that can help safeguard your wealth through all of it: diversification. Stay with us until the end of this video, where we'll not only explain why diversification is critical for protecting your wealth, but also reveal some key strategies you can start implementing right now to secure your financial future. Why diversification is essential for wealth protection. Diversification is more than just a buzzword you hear in finance. It's a strategy that investors have used for decades to protect their wealth. But what does it actually mean? In simple terms, diversification is the practice of spreading your investments across various assets to reduce risk. Think of it as not putting all your eggs in one basket. If you drop one basket, not all your eggs will break. The same logic applies to investing. Many investors make the mistake of concentrating their wealth in a single type of asset, like stocks, real estate, or even a business. While this can sometimes lead to huge gains, it also exposes you to a significant amount of risk. If that one asset class takes a hit, your entire financial foundation can be shaken. Diversification reduces that risk by ensuring that if one investment loses value, others in your portfolio can help offset the loss. The different types of diversification. Now that we understand the importance of diversification, let's talk about how to actually do it. Diversification isn't just about buying different stocks or investing in different companies. True diversification involves spreading your wealth across different asset classes. This means investing in stocks, bonds, real estate, precious metals, and other financial instruments. Each asset class behaves differently under varying economic conditions. For example, when the stock market is down, bonds often perform better. When inflation rises, commodities like gold tend to hold their value. By having a mix of assets, you protect yourself from the swings of any one market. Another type of diversification is geographic diversification. This means spreading your investments across different regions of the world. By investing in both domestic and international markets, you're not just relying on the health of one economy. For instance, if the US stock market has a downturn, markets in Asia or Europe might still be performing well, providing a cushion for your portfolio. Global diversification reduces your vulnerability to the political and economic issues of any single country. Avoiding overconcentration in any single investment. One of the biggest mistakes people make when it comes to managing their wealth is putting too much money into a single investment. This is especially common with business owners who have most of their assets tied up in their own company. While it's great to have confidence in your business, relying too heavily on it can be risky. If the industry changes, competition increases, or your company experiences financial trouble, you could lose a significant portion of your wealth. This doesn't just apply to business owners. Many people fall into the trap of overinvesting in a single stock or industry. It's easy to get excited when a stock is performing well, but it's essential to remember that no stock goes up forever. The same goes for sectors like technology or real estate. If you have a large portion of your portfolio concentrated in one sector, a downturn in that industry can have disastrous effects on your overall wealth. Avoiding overconcentration is a fundamental part of diversification. Balancing risk with return. Another key benefit of diversification is the ability to balance risk with return. Every investment comes with a certain level of risk. Stocks, for instance, tend to offer higher returns but come with more volatility. Bonds, on the other hand, are typically safer but provide lower returns. By holding a mix of high-risk and low-risk assets, you can create a portfolio that aligns with your financial goals and risk tolerance. For example, a younger investor with a long-time horizon might choose to allocate more of their portfolio to stocks as they have more time to weather market volatility. Meanwhile, someone nearing retirement might prefer to hold more bonds and other low-risk assets to protect their wealth from market downturns. Diversification allows you to tailor your investment strategy to your specific financial situation, ensuring that you're not taking on more risk than you're comfortable with. Rebalancing your portfolio over time. One of the most critical yet often overlooked aspects of diversification is the need to rebalance your portfolio periodically. As markets fluctuate, your portfolio's asset allocation can shift, exposing you to more risk than you originally intended. For example, if your stock investments perform exceptionally well, they might start to make up a larger percentage of your portfolio than you initially planned. This increases your exposure to market volatility. The role of alternative investments in diversification. When people think of diversification, they often focus on traditional assets like stocks and bonds. But true diversification also involves exploring alternative investments. These can include assets like real estate, private equity, hedge funds, commodities, and even cryptocurrencies. Alternative investments often behave differently from traditional markets, which can provide additional protection for your wealth. For example, real estate tends to have a low correlation with the stock market. This means that if the stock market is underperforming, your real estate investments might still be doing well. Similarly, commodities like gold are often seen as a hedge against inflation. While alternative investments can add another layer of diversification to your portfolio, it's important to remember that they also come with their own risks. Some alternative investments are less liquid and more difficult to value than traditional assets, so it's essential to do your research before diving in. Diversification through multiple income streams. Diversification isn't just about how you invest, it's also about how you earn. Relying on a single source of income can be risky, especially in today's uncertain economy. One of the best ways to protect your wealth is by building multiple income streams. This can include passive income sources like dividends from stocks, rental income from real estate, or earnings from a side business. Having multiple income streams provides a financial safety net. If one source of income dries up, you'll still have others to fall back on. This not only helps you protect your wealth, but also gives you more flexibility and financial security in the long run. The more diversified your income streams are, the less vulnerable you are to financial setbacks. Diversification is not a one-time task. It's an ongoing strategy that requires attention and adjustment over time. The beauty of diversification lies in its ability to protect your wealth without limiting your potential for growth. By spreading your investments across different assets, industries, and geographies, you minimize your risk and ensure that no single event can wipe out your financial progress. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.